The video delves into the lesser-known narrative of the Great Depression, revealing how while millions of ordinary people suffered economic devastation, a small group of billionaires and financial elites capitalized on the chaos to consolidate and expand their wealth and power. Figures like Joseph P. Kennedy, the Rothschilds, Jesse Livermore, and the Rockefeller family understood the market dynamics and timing, enabling them to profit enormously from the 1929 crash and subsequent economic turmoil. Their strategies involved short-selling overvalued stocks, buying distressed assets cheaply, diversifying across industries, and leveraging political influence to shape recovery policies favorably. The Great Depression was not merely a failure of capitalism, but a deliberate reorganization that weeded out weaker players and concentrated wealth in fewer hands. Central to this was the Federal Reserve's monetary policies, which facilitated a liquidity crunch that triggered the crash. The crisis served as a filter that favored those with cash, knowledge, and connections, while the majority lost homes, jobs, and savings. Government interventions such as Roosevelt's New Deal and the gold confiscation policy, ostensibly aimed at recovery and reform, actually reinforced the existing power structures by channeling public funds through established elites and limiting ordinary citizens' access to real money. The consolidation extended beyond finance into industry, agriculture, media, and infrastructure, with families like the DuPonts and Melons expanding their empires. Philanthropy and public works became tools to entrench influence and reshape public perception. The Depression era's end coincided with World War II, which further amplified the wealth and power of these industrialists through government contracts and wartime production. Post-war, the same elites shaped the global financial order, education, and policy, embedding their worldview and preserving their dominance. The video underscores a recurring pattern. Economic crises serve as moments where wealth transfers upward, concentration intensifies, and those prepared and connected emerge stronger. This blueprint repeats through history, from 1929 to 2008 and beyond, highlighting how systemic inequality is not accidental but structurally embedded. Understanding this cycle allows a clearer view of economic events and challenges the narrative of fairness often presented during recoveries. The Great Depression didn't just erase wealth, it rearranged the entire architecture of American power. And while ordinary families watched their lives unravel like thread pulled from a fraying coat, a very small circle of men recognized something different. Chaos wasn't a disaster. Chaos was an opening, a once-in-a-century chance to reshape markets, industries, and institutions in their favor. As markets collapsed in slow motion, day after day, the average American clung to hope. They believed the crash was temporary, a correction, a momentary downturn. That optimism kept them holding on to stocks that were already destined to fall another 50, 70, even 90%. But the elites, the men with access, advisors, and insider whispers, didn't cling to hope. They clung to mathematics. They clung to patterns. They clung to fear as a tool. Joseph P. Kennedy was one of them. A savvy, ruthless, cold-eyed operator who understood that markets don't move on truth, they move on sentiment. And sentiment, once poisoned, spreads like smoke. Kennedy saw the mania of the late 1920s for what it truly was, a fever. A fever fed by margin loans, wild speculation, and a belief that stocks only move in one direction, up. He shorted the market with precision. And when the fever finally broke, he was already positioned to profit from the catastrophic fall. While banks failed, while unemployment soared, while breadlines wrapped around city blocks, Kennedy's net worth surged. He wasn't alone. Jesse Livermore, the legendary trader, read charts like generals read maps. He watched volume spikes, irrational surges, the strange quiet before panic, and he bet against the bubble with a level of confidence that bordered on clairvoyance. His profits during the crash were so large they became mythic. Wall Street called him the boy plunger. But during the fall of 1929, he became something else. A man who made more money in a week than entire cities earned in a year. Then there were the old families. The Rockefellers, the Rothschilds, the Melons. These weren't traders riding waves. They were architects designing them. When the crash began, they weren't scrambling. They were watching. They understood that the Depression would force weak businesses to sell, that landowners would default, that companies with real assets, factories, farmlands, railroads, ports, would suddenly be available for pennies. And they were ready with cash. Cash was the scarcest resource of the Depression, and those who had it were not suffering. They were shopping. Factories that once cost $10 million were bought for $800,000. Banks that served thousands were absorbed overnight. Farmland, steel plants, energy companies, quietly acquired, piece by piece. It wasn't chaos to them. It was clearance pricing. As the Federal Reserve tightened liquidity, starving the system of dollars, the elites with deep reserves of gold, foreign accounts, and diversified holdings weathered the storm with almost surgical detachment. Every day the public grew more desperate. Every day the wealthy became more powerful. Roosevelt's New Deal, hailed as a savior for the struggling class, also carried a hidden truth. The massive public works projects required corporate partners, steel for bridges, machinery for dams, wealthy financiers for bond underwriting. And guess who owned the steel mills? Guess who controlled the railroads? Guess who handled the bond markets? The same families who had profited from the crash profited again from the recovery. Even the gold confiscation of 1933, a policy blamed on protecting the dollar, played directly into elite hands. Ordinary citizens handed over their gold at a fixed price. But major financial institutions, those with international affiliates and offshore storage, avoided much of the impact. And when the government revalued gold from $20.67 to $35 an ounce, guess who saw the windfall? It wasn't the American worker. By the late 1930s, wealth concentration had reached levels unseen in American history. The Depression had reshuffled the hierarchy, tightened the circle, and magnified the influence of those already at the top. The public saw men ruined, banks shuttered, farms lost. But behind the curtain, a different picture formed. A concentration of capital so dense that it quietly set the stage for the next era, wartime production. And the families who entered World War II wealthy left it unimaginably richer. Factories that once produced tractors turned into weapons manufacturers. Oil fields that once powered farms now powered fleets. Financiers who once underwrote corporate bonds now underwrote nations. The Great Depression didn't just expose inequality, it engineered it. It created a filter where those with knowledge survived, those with liquidity dominated, and those with political access rewrote the rules. And that pattern, that upward transfer of wealth during crisis, didn't end in 1939. It repeated in 1971. It repeated in 2008. It's repeating now, because the system isn't broken. It's designed. The strange thing about prosperity is that it blinds people right when they should be paying the most attention. And in the late 1920s, America wasn't just prosperous, it was euphoric. Ordinary families were buying stocks with borrowed money. Barbers, farmers, secretaries, taxi drivers, everyone believed the market could only rise. Newspapers celebrated record highs every week. Bankers reassured the public that this time was different, that America had tamed the business cycle. But behind the glowing headlines and champagne optimism, a very different class of Americans saw something else forming, something dangerous. They saw credit expanding faster than wages. They saw corporations manipulating their own stock prices. They saw the Federal Reserve quietly tightening liquidity while the public cheered the bull run. They saw the exact pattern that always comes before a collapse. And unlike the millions celebrating, these men didn't ignore the warning signs. They prepared for them. Joseph P. Kennedy was one of the first. He had built his fortune studying human behavior, not charts. And the behavior he saw in 1928 and 1929 reminded him of something he'd learned early in life. When shoeshine boys start giving stock tips, the market is out of control. Kennedy began quietly unloading his positions, even as the public continued buying. He saw the way leverage was piling up like dry timber. He knew one spark could turn the entire market into a firestorm. But he didn't just step aside from the coming disaster. He positioned himself to profit from it. He shorted the market while America was still celebrating. And he wasn't alone. Jesse Livermore, legendary trader and a man who understood panic better than any economist, was watching the market's psychology fracture. He'd lived through crashes before. He recognized the silence that comes right before the fall, that eerie, hollow calm. And so, while brokers reassured the public that prices were stable, Livermore quietly placed some of the largest short positions in financial history. When the crash came, it was fast. The proud illusion of endless prosperity collapsed in a matter of hours. Phones rang unanswered. Banks failed in slow motion. Trading floors descended into chaos. America gasped, but Kennedy and Livermore did not gasp. They collected. Livermore walked away with what would be nearly $1.5 billion in today's money. Profit made in days, while millions lost everything. Kennedy's fortune multiplied. The Rockefellers, who had diversified aggressively into industries that survived downturns, expanded their influence. The DuPonts grew their control over chemicals, manufacturing, and warfare technologies. The Mellon family deepened their hold over banking and industry. And this was only the beginning. Because when America was at its weakest, when homes were being repossessed and unemployment lines stretched down entire city blocks, these families did what powerful families always do during a crisis. They went shopping. Factories, railroads, newspapers, shipping companies, steel mills, all sold at a fraction of their real value. Distressed assets, fire sale prices. Entire corporations could be bought for the cost of their equipment alone. Regular people couldn't buy anything. They were struggling to eat. But the billionaires? They were consolidating America. And every purchase tightened their influence. Over industry, over legislation, over the future shape of the economy. The Federal Reserve's decisions that starved the economy of liquidity and deepened the depression, only accelerated this transfer. Crisis was a filter, and only those with cash, knowledge, and political reach passed through. While most Americans lived through a decade of despair, the elite lived through a decade of expansion. And beneath the surface, one more force was quietly transforming America: the government itself. Roosevelt's policies, publicly sold as relief and reform, funneled enormous power and resources into the hands of the same industrialists who already controlled the economy. Construction contracts, infrastructure projects, manufacturing deals, agricultural subsidies. The people saw jobs, but the elite saw something much bigger: a chance to rebuild America in their image. World War II took this even further. Factories owned by the same Depression-era giants were now central to the war machine. Government money, public money, flowed into private empires. And by 1945, the gap between ordinary Americans and the crisis billionaires wasn't just larger, it was permanent. The Great Depression wasn't only a collapse, it was a reset, a redistribution of power disguised as an economic tragedy. And the blueprint it created has been repeated again and again. 2008 followed the same pattern, and the world is drifting dangerously close to another version of it. And then everything snapped. The wealth gap that had been widening quietly in ledgers and boardrooms finally exploded into plain sight. By 1932, the country was split into two Americas, one standing in breadlines, the other buying entire industries at liquidation prices. It was the moment you see the whole machine without the mask. While mothers wrapped their children in newspapers to survive the winter, a handful of financiers were walking through the ruins with shopping lists. Railroads, steel mills, oil fields, banks. Entire empires were being bought for pennies by men who had spent the crash preparing, watching, waiting. Joseph P. Kennedy was appointed to police Wall Street after making a fortune exploiting it. Jesse Livermore, the man who predicted crashes like he was reading weather reports, walked away with more money than some states had in their treasury. The Rockefellers quietly absorbed collapsing companies and emerged even more untouchable than before. The narrative of shared suffering was a myth. The Depression wasn't just a downturn, it was a controlled burn. A fire that destroyed the weak but cleared the forest for the powerful. Families lost homes, but bankers gained neighborhoods. Workers lost wages, but industrialists gained entire supply chains. The country felt like it was dying, but for the elite, this was rebirth. And in the final twist, as Roosevelt swept into office with promises of reform, the same billionaires who helped break the system were invited into the room to redesign it. What came next wasn't a rescue. It was a restructuring, engineered to make sure the next crisis would never again threaten those at the top. That was the moment America learned a quiet truth. The system doesn't collapse, it resets for someone else's benefit. When America finally crawled out of the Depression, the country wasn't the same. The skyline looked familiar, but the power map beneath it had been completely redrawn. The families who survived the crash didn't just recover. They reinvented the system in their own image. They sat on the boards that rewrote market rules. They funded the think tanks that shaped economic doctrine, and they advised the government officials who taught the next generation how the economy works. And it worked, just not for everyone. The billionaires who came out of the 1930s understood something the public never fully grasped. Crisis is not the end of wealth, it is the redistribution of it. When a system collapses, value doesn't disappear, it moves. And they made sure it moved upward. Factories closed, but the surviving industrialists bought the land underneath them for pennies. Banks failed, but the connected few absorbed their assets and customers with government help. Stocks collapsed, but the players with liquidity bought entire industries like clearance items. Families lost farms, but agricultural dynasties expanded their holdings quietly, methodically, legally. The Great Depression did not flatten America, it stratified it. By the end of World War II, the same elite families and financiers who weathered the 1930s were suddenly the pillars of the new global order. Their money built universities and cultural institutions. Their names and foundations appeared on hospitals, museums, international treaties, and nonprofits that quietly influenced policy. And behind every act of charity was the same truth. They were shaping the future so it never again threatened their position at the top. The most powerful lesson of this period isn't about greed. It's about structure. Because the Great Depression didn't just reveal who controlled capital. It revealed who controlled the rules that govern capital. The crash didn't create these elites. It simply exposed the blueprint they had been perfecting for generations. Stay liquid when others are leveraged. Stay informed when others are hopeful. Stay connected when others are isolated. And when the system breaks, by the pieces. That pattern has repeated in every major crisis since, from 1973 to 1987 to 2000 to 2008, and even in the most recent collapses. Every shock becomes a sorting mechanism. Every downturn becomes a transfer. Every crisis becomes an opportunity for someone. And the uncomfortable truth is that the people hit hardest are almost never the ones who caused the disaster. They're simply the ones with the least protection when the storm arrives. Because in the modern financial world, wealth is not just about money. It's about timing. It's about access. It's about understanding how the machine really works. And if you take one thing from the Great Depression, it's this. The people who suffer the most in an economic collapse are rarely the ones who prepared for it. And the people who rise afterward were planning before it began. History doesn't reward panic. It rewards positioning. And in every era, the same small circle of players knew exactly where to stand. If you want more deep dive documentaries that expose how money, power, and crisis really work, subscribe. You not just watching history, you relearning the playbook the elites still use today.